some investors have been a bit hesitant to really cash out on some of these positions because of the tax implications.
What would you say the biggest frustration is with capital gains tax as it pertains to exiting cryptocurrency that you found? And also talk about just timing, right? When markets go high, markets go low, people want to get out, but they don't want to get hammered with the tax, and maybe they hesitate. Kind of tell me like what you feel like the last, from the last crypto crash when Bitcoin was, let's say 68, 69,000 and it crashed down and everything else kind of with it too. Give us kind of that overall feel of, when you go to exit in capital gains tax.
Yeah, so it's a can of worms question. I would say that it's definitely changed even over the years. So many years back, I mean, I've been involved in blockchain and crypto for going on 7 years now, and in the 2010s, at a certain point, the tax laws, for example, in the United States, were different around digital assets than they are today, and likely things will continue to evolve in the United States as well as in different various other countries. But one notable consideration around this is to your point, Brett, capital gains in general. Short-term as well as long-term capital gains. So this really depends country to country. And by the way, it's not tax advice. Do your own research. Consult with with your tax professional about your own situation. But for example, in some countries, there is significantly higher short-term capital gains tax on these assets versus long-term capital gains tax. Again, depends on the jurisdiction we're talking about. But in general, needing to evaluate the tax potential on a trade-by-trade basis is something that is significant to the digital asset space. That there's a lot of volatility in these assets, and when you are when you have volatility, you have opportunity, but you also have risk. But thinking through the tax implications, for example, in many jurisdictions, if you are going from US dollars into Bitcoin, and then from Bitcoin into another digital asset such as Ethereum, and then from Ethereum into another digital asset such as Litecoin, at each of those points, there's a moment that needs to be evaluated in terms of the potential from a tax perspective. And back to another point you made, Brett, thinking through some of these really sizable bull runs in the digital asset space, some investors have been a bit hesitant to really cash out on some of these positions because of the tax implications. Some areas that are starting to develop around this, though, are, for example, collateralized loans. So much like a investor might take out a loan on stocks or a mortgage on a property to capture a bit more liquidity without a taxable event. This is also becoming an increasing facet of the digital asset economy. Another area that's starting to become popular, for example, in the United States, is self-directed IRA accounts with digital asset exposure, where there's ability to kind of invest without some of those considerations. And then beyond that, though, for example, from the Cayman wealth management perspective, a Cayman fund itself as an investing entity does not pay those taxes on a trade by trade basis as an organization. Certainly, and of course, a investor from any jurisdiction that's investing into a Cayman vehicle has a duty and responsibility to pay their fair share of taxes to their governing tax body, be that in the United States or in Hong Kong or Australia or what have you. But to that point about capital gains, for the institution, one thing that is helpful about that Cayman structure is that it can separate out the tax consideration for the overall investing institution, can separate that out from the question of what is going to be the best investing decision for the group itself. And so that can reduce a significant amount of the kind of the let's say friction in the decisioning at a group investment level.